You know, there are few things that cause more headaches for tax pros than trying to figure out how to handle a client's legal settlement. The biggest risk? Your client gets hit with a huge and completely wrong self-employment tax bill. So today, we're going to break down the entire process, from the core legal principles to the exact lines you need to use on the tax forms so you can handle this like a pro.
So, here's the plan. We're going to start by exposing the root of the problem, which is what I call the IRS's automated matching trap. Then we'll build our defense, step by step, using a couple of foundational legal concepts. After that, we'll get into the nitty-gritty of the reporting forms and the precise mechanics for filing correctly. And we'll wrap it all up with a handy checklist for practitioners, just to make sure you're always ready.
You see, the core problem here is really a classic battle: automation versus nuance. The IRS, as you know, relies on these powerful but very rigid computer systems that just can't see the critical legal distinctions that come with settlement income. And that creates a pretty significant and honestly an all too common tax trap for anyone who isn't paying close attention.
So here's how this trap actually springs on you. The IRS's Automated Underreporter program, the AUR, it runs on a very simple rule. If it sees a Form 1099 NEC, it just assumes it's business income. That means the computer is automatically looking for a Schedule C, and it expects to see self-employment tax paid on that income. The system just doesn't know any better. It has no way to ask, hey, was this payment for actual services, or was it for something totally different, like damages from a defamation lawsuit?
And believe me, the stakes here are absolutely huge. We are talking about a 15.3% tax rate. Getting this wrong can blow up a client's tax bill by over 15% right off the top. This isn't a small rounding error, folks. It can be a financially devastating mistake. So let's build the legal argument to make sure this never happens. All right, so how do we fight back? Well, that brings us to our first key weapon in the arsenal: the origin of the Claim Doctrine. This is the legal principle that really matters most. It's not about which 1099 form was issued. It's all about the fundamental reason why your client got paid in the first place. Now, the origin of the Claim Doctrine sounds complicated, but it's pretty simple in theory and incredibly powerful in practice. It basically forces us to put on our detective hats and look through the settlement payment to the original legal claim that started it all. We have to ask that one simple question: what is this money replacing? And the answer to that question is what dictates the tax treatment, not the piece of paper from the IRS. And I want to be clear, this isn't just some clever argument we cooked up. This is bedrock law, established by the Supreme Court. The doctrine was first laid out clearly in a case called United States v. Gilmore, and then it was fine-tuned in Woodward v. Commissioner. Just being able to cite these cases gives your position some serious legal weight if you ever have to respond to an IRS notice. And here it is, right from the court's own words. The key phrase is origin and character of the claim. The test isn't about the consequences of the lawsuit. So a taxpayer can't just say their legal fees are a business expense because losing would have wrecked their business. And by that same logic, the IRS can't say a settlement is business income just because it helped the client financially. No, you have to look to the source. Okay, so let's break this down. When you apply this in lieu of test, everything starts to fall into place. If the settlement money is replacing lost wages, well, it gets taxed like wages on a W-2. If it replaces lost business income from a sole proprietorship, then yeah, it belongs on a Schedule C. But, and this is the one to really watch out for, if it's for damage to a person's non-commercial reputation, it's just other income on Schedule 1. That means no self-employment tax. This is where so many of the errors happen. All right, that's pillar number 1. Now let's talk about the second piece of this legal puzzle. Because even if income is taxable, it's only subject to self-employment tax if it comes from a trade or business. And that phrase has a very specific legal definition. So the big question becomes, what is a trade or business anyway? Because Internal Revenue Code Section 1402 says self-employment tax applies to earnings from a trade or business. But here's the catch: the code itself never actually defines the term. For that, we have to look to the court cases surrounding Section 162, which is the section that deals with business expenses. And this is where another Supreme Court case, Commissioner v. Grozinger, delivers the knockout punch. The court made it crystal clear: for an activity to be a trade or business, the taxpayer's involvement has to be continuous and regular. Well, a lawsuit is basically the opposite of that. It's a one-time sporadic event. I mean, think about it. Is your client in the business of filing lawsuits? Probably not. So receiving a single settlement just doesn't meet that Grozinger standard.
All right, so we've got the law on our side. Now let's switch gears and talk about the practical side of things, the forms themselves. Because the way the other side reports the settlement can either make your job super simple or force you to play defense with the IRS.
This table really lays it all out perfectly. On one hand, you've got the Form 1099 MISC with the income reported in Box 3 for other income. This is the dream scenario. The IRS instructions even list damages as something that belongs here. It flows beautifully right to Schedule 1 Line 8Z, and the matching computers don't blink an eye. But then you have the 1099 NEC. And this is where the trouble starts. Box 1 is for non-employee compensation, and the IRS computer system is hardwired to assume that anything in that box is Schedule C income. Plain and simple.
Oh, and by the way, here's a quick heads up on something coming down the pike. For decades, as you know, the 1099 reporting threshold has been a measly $600. Well, that's finally changing. A new law, Public Law 11921, raises that threshold to $2,000. Now, this is for payments made after the end of 2025, so it's going to first impact the 2026 tax returns that we'll all be filing in 2027. Just something to keep on your radar.
Okay, this is the moment we've been building towards. We've got the theory, we know the forms. Now, how do we actually put this on the tax return to get the right answer and, most importantly, avoid that dreaded CP 2000 notice from the IRS? Let's start with the easy one. If your client gets that beautiful 1099 MISC with the income in Box 3, you are in great shape. You just pop that number right onto Schedule 1, Line 8Z. The key here is to use a really clear description, something like lawsuit settlement, non-physical injury. This method is clean, it's direct, and it has a very, very low risk of getting flagged by the IRS. But what happens when the other party messes up and sends a 1099 NEC? You can't just ignore it and put the income on Schedule 1 because the matching computer will almost certainly send a notice. So instead, we use a really slick technique often called the in and out Schedule C. Here's how it works. First, you report the 1099 NEC amount on Schedule C, Line 1. This makes the matching computer happy. Then you expense the exact same amount on Line 27A, and you label it clearly Taxable Settlement Not SEI Income. This zeroes out the Schedule C, which means zero self-employment tax. And then, for the final step, you report the income where it actually belongs, on Schedule 1, Line 8Z. All right, we've covered a ton of ground. Let's boil it all down into a final checklist. Think of these as the critical action items to remember anytime you're faced with one of these cases.
So to recap, first, always start by analyzing the origin of the claim using that Gilmore doctrine. Second, use the Grozinger continuous and regular test to destroy any argument that this is from a trade or business. Third, manage the forms proactively. If you can, try to get a 1099 MISC specified right in the settlement agreement. If you do get stuck with a 1099 NEC, use that in and out strategy we just covered. Fourth, don't forget to warn your clients that, thanks to tax reform, their attorney fees are generally not deductible anymore. And finally, if it feels like a high-risk position, consider filing a Form 8275 disclosure statement. It can be your best protection against accuracy-related penalties.
So what's the bottom line here? It's this. In an age where the IRS relies more and more on automation, our job as practitioners is to be the human element, the element of nuance. Creating an impeccable paper trail, thoroughly documenting the origin of the claim, the sporadic nature of the event, and the legal justification for your reporting, that's not just good practice anymore. It's the essential defense you are going to need for your client when, not if, the algorithm flags the return.